Good morning to everyone this nice spring May morning. I'm Ed Bartling, your internal wholesaler for financial markets. And first of all, I want to say thank you for a terrific kickoff in 2021. We look forward to working with you for the balance of the year there. Again, thank you for your business. And indeed, this is a special group that is here today that I have the privilege to talk to this morning, because preparation for tomorrow begins today. You're here to educate and motivate your clients. We know this. And preparation doesn't begin with what you do. It begins with what you believe. If you believe that your success tomorrow depends on what you do today, then you will treat today differently. And indeed you did. You've taken time to invest your time to get some more information on that need of long-term care. You know, many Americans moved in with their loved ones to take care of them during the pandemic. This probably made them painfully aware of the importance of being financially prepared for long-term care in their future. Before we get into the topic and the presenter today of Brent DeGroot, Regional Sales Director, just a couple housekeeping. Everyone's line has been muted. Please use the chat on the little box there on the right-hand side there to bring us your questions. We will have time for those. And at the end of the presentation, one lucky attendee will be receiving a $50 Amazon card. When planning for long-term care needs with your clients, OneAmerica has some distinctive advantages. This presentation this morning by Brent DeGroot will cover the market advantages of the care solutions OneAmerica has to offer. You will come away, indeed, equipped with the knowledge and tools to put together a total peace of mind long-term care plan for your clients, and you're going to feel good about it. Yes, preparation for tomorrow begins today. Brent DeGroot, Regional Sales Manager, is an industry veteran. Brent began his career about 20 years of knowledge in the long-term care and life brokerage space. Prior to joining OneAmerica in 2019, Brent spent more than 10 years with Mutual of Omaha, developing relationships and achieving success with brokerage distribution partners. He has also worked for the American Enterprise and owned an agency in Phoenix, Arizona. So he's been boots on the ground, where he began his career in 1998. Now he holds professional designations of the CLTC and the LTCP designation. A graduate of the University of Nebraska, Omaha, Brent resides with his family in Omaha, Nebraska. And without, as they say, further ado, I have the pleasure of introducing Brent DeGroot, LTCP, CLTC. Good morning, Brent.
Well, good morning, Ed, and thank you for that introduction. Certainly appreciate that, and everybody that came out this morning. Certainly appreciate your time and attention this morning, and really wanted to give you some market advantages that we have here at OneAmerica when planning for long-term care, and they all have to do with our asset-based long-term care. Couldn't agree more with you, Ed. Planning starts today, and one of the challenges that I have recognized over my 20-year career in the long-term care space is, certainly starting that planning process, planting the seeds, talking to our clients about the risks of an extended care event, whether it's in their retirement years or even pre-retirement years. And so I think it's vitally important that we always discuss this, plant those seeds. I'm going to give you some takeaways here at the end of this presentation to kind of help do some of that for you, trying to make that process a little bit easier. But again, Ed and everybody on the call, thank you this morning. Let's get into the presentation here. So I really want to cover 5 key advantages of our care solutions portfolio. First and foremost, the catastrophic protection or offering a lifetime income stream that a needed care recipient cannot outlive. And that is true catastrophic planning. So that gets back to kind of insurance 101. We protect against the things that we can't, we don't know, and then use our resources for other things to pay bills and, you know, lifestyle and that sort of thing. But you always want to get rid of that catastrophic risk. And that's what insurance really is all about. So I'll be talking about our lifetime benefit structure here in just a minute. I'll also talk about joint coverage. And if you couple that with that lifetime income stream for long-term care expenses that you can't outlive, that's really what, when Ed was talking about that total peace of mind, customers really like that total peace of mind knowing that they can never outlive any type of extended care need that they have. And when I'm going to talk about joint coverage, I don't want to get too ahead of myself here, but now we can cover both of those spouses in one policy. So I'll leave it at that for now, and we'll hit that as we go through here. I also want to talk about using qualified money. Many advisors, financial professionals don't understand that we can use qualified funds to create a great long-term care plan for their clients. And I want to give you some ideas and ways to do that here. Also want to talk about our structure. Here at OneAmerica, we have both a life-based structure and an annuity-based structure or solutions that can be used to create that long-term care plan. And I'll get into that here in just a little bit. I can't help but mention our 30 plus years of experience. We actually sold our first asset care, which is our life-based chassis solution back in 1998, which is actually, 1988, which is actually the year that I graduated from high school. So we've had a long time in developing these types of plans, administering these types of plans, and certainly when the rubber meets the road, paying claims on these types of plans as well. So a lot of great experience there. You know, there are a number of our competitors out in this space that have just come within the last 5-10 years and maybe don't have the extensive book of business and knowledge around how to price these solutions and that sort of thing. So, you know, always good when you're trying to build a plan for your clientele to make sure that you're with a very financially strong, stable, and secure company, and one that's got the experience to back it. Last thing I wanted to give you through this presentation today is really a turnkey marketing website. And I know that when the invitations for this webinar went out, it was really mentioned OMS, you know, not that the insurance industry needs another acronym, but that stands for One America Marketing Store. And I really want to talk about that and what's available to you there as well. Whoops. And then I also wanted to go through some quick case studies as we kind of go throughout this presentation. So little agenda slide there, and let's get into why catastrophic protection. Well, I liken it back to, you know, if you're buying any insurance product, why really are you doing that? You know, when we're talking about auto insurance, are you buying it just for that windshield replacement when you happen to be traveling down a highway or an interstate, and sure enough, you get behind a truck and it kicks up a nice little rock and you get one of those nice little creeping cracks in your windshield, you know, or is it really that you buy it for these total car crashes? You know, we can all probably afford a new windshield, although these are getting more and more expensive this day and age. But we really purchase that for the total crash. When your car is completely totaled, that's why you're buying that insurance. If I'd liken it to, you know, a homeowner's policy, are you buying it just for the roof replacement when we have hail damage or wind damage or tornado damage? No, you're really buying it for in case there's a total loss, destruction. That could be from a tornado as well, but fires, any type of situation that is certainly more than just a roof. And then, if we had to talk about kind of our physical health, maybe it's our mental health. Are you buying health insurance for care that is needed for 6 months through 6 years? Or are you really looking to cover any of those severe cognitive impairments like a dementia or Alzheimer's, Parkinson's, that can really leave you needing care or the clients needing care for possibly up to 20 years or more? And so again, you just need to ask yourself, why are you buying the insurance? And largely it comes back to covering the catastrophic. So I'm going to give you, I'm a visual learner, and I like to give you this little example here because I think that this really can explain why lifetime matters. A lot of our competitors out in the market space, kind of fall subject to the average trap. And that's what I'm going to call it. Like you can't see me, but my fingers are up in the air doing the air quotes, if you will. So falling victim to that average trap, meaning that they're only planning for the average need of care. And essentially, if we looked at the averages from the LTCi, it does talk about that, a male needs care for an average of 2.7 years, and a female needs it for 3.6 years of care. So yes, that's the average, but the average only tells you one thing. When you compile all those claims together, that gives you the average, right? So there are certainly some that are less than the average and certainly some that are more. So if I brought this little line in here, let me show you the average of this dot plot matrix that I have on here. So each one of those blue dots represents a long-term care claim. And if we're going to fall subject to that average trap, that's what you do. You plan for the average for that little, I guess it's orangish red line there, right in the middle. So actually 9 of those blue dots touch that red line. So in those particular situations, great. You planned for the average, you gambled, and it worked. Even for those below the line, if they're only planning for the average, that worked. But look at all of those above the line as well. And now you put this great plan of care in place, but because the client didn't, maybe that's where they wanted to only plan for the average. Maybe that objection from them or came directly from them saying, look, what's the average need of care? I only want to plan for that. Well, if you do that, you put a plan of care in place, and now they have one of those, dementia, Alzheimer's, Parkinson's needs, and they well outuse any plan that they've had in place. You put that plan in place to really help protect their retirement savings, their, hard-earned income that they put away. Obviously, that's earmarked for their retirement plans, and they didn't want to invade that for any long-term care expenses. So you put this great plan of care in place, but it only planned for the average. Now they need more care. They've exhausted their policy, and now they're going right back to that same retirement portfolio to draw funds to pay for any needed long-term care expenditures. Why lifetime matters, why our unlimited benefits structure matters, is because of this one reason. By planning for the catastrophic, it doesn't matter if they had a very short claim time or an incredibly long claim time. Each one of those blue dots there that represent a long-term care claim had a lifetime income stream that they could never outlive. So again, I'm a visual learner. I really like this solution, and I just wanted to make sure that hopefully that point hits home with you as well. But let's talk about some of the longest claims that are out there. Now, this is getting a little older now that we're into 2021, although most people would say that 2020 was a throwaway year due to COVID. But we've got, some of the longest claim periods and amounts that are being paid out. Some of these still could be paying today. But if we look at some of these claims, it's amazing. $2.3 million. You know, if they only plan for the average, how quickly are they invading that retirement portfolio that they were planning for from the get-go? Obviously, they could deplete it all. Second one here, if you look at the average, or excuse me, the amount of time that was happening here, this is for a male. This is another misconception that's out there. Everybody thinks that females are going to last longer, thus their care is greater as far as the averages are concerned, and maybe their costs for a long-term care plan are greater as well. But look at in company 2 here, 19 years and 3 months. I mean, that's an incredibly long period of time for this male versus the longest female that they had, which is only 15 years and 4 months. But that misnomer that the females are always going to need care longer is not necessarily true. And then again, we just look at company 3 here, still over $2 million in the amount of claim dollars that were paid out for claims. So are we only protecting for the average or planning for the average? Probably not the best way to go with our clients. And if you want to get that true peace of mind that your customers really want, it's always planning for the catastrophic. And when I say that that's true peace of mind for your clients, I want to say that's also true peace of mind for you as a financial professional as well. Because when you've planned for that catastrophic need, you don't have to worry about the clients that you put this plan in place now blowing through that whole plan that they had and now starting to invade their retirement portfolio again. So not only does it give them peace of mind, but it really should give you that same peace of mind. And that's where I talk about true peace of mind for all parties involved. Next, I want to talk about our joint coverage, because our structure as it stands here at OneAmerica is the fact that we have a joint second to die structure on our asset care solutions. And the reason I mention that is all of our competitors do it in an individual basis. So they must be individual policies. But because we've got this joint structure, you know, spouses now they share everything else, don't they? Now they can share their long-term care plan as well by having the same policy or the same death benefit to draw from. And this slide really kind of goes over, if you're like me, you know, you've probably looked at some slides like this before, and you're typically looking at some of the numbers and you're saying, gosh, why does OneAmerica want to show these premium differences where they're the greatest? Well, I want to caution you there. Look, I fall subject to that as well, but here's really what this has done. I looked at our competitors in this space, and because they're on an individual basis, I said, okay, here's what we're going to have. We're going to have $75,000 for the male and the female here, and we're going to build plans specifically for them. With us, we get a couple that 75 for each of those individuals and pool it together. So now we have a joint plan of $150,000. So the premiums are exactly the same. But here's what happens. You know, if you look at on an individual basis with some of our competitors, because long-term care insurance planning is now gender specific, what happens many times is if those spouses are going to put in the same amount of money, they're not going to get the same amount of benefits. And if you want some animosity to build within that particular marriage, you know, offer them different benefits. Or if they want to get the same benefits, now one of those spouses is paying more for that coverage. And again, that's not a situation that you want to put yourself into. You're just adding some fuel to the fire, or putting some doubts in their mind about that, because they're not having the same amount of benefits or the same premium dollars. When we can put those together in our joint second to die structure, we get a pool, both of that $75,000 that we're putting into these policies. Now we have a larger premium to put into our plans. Typically that will equate to giving a larger death benefit because we have more than just $75,000. We've actually doubled that and $150,000 in this particular scenario. So that'll give us more death benefit. What that also does is allows both of those clients, because they're both going to receive benefits out of that death benefit, that allows them to have the exact same benefits, same premiums, same benefits. But look what this also talks about here. You know, our competitors will only offer up to 6-year plans because they've really planned for the average need of care. So not only can we, with our joint policy structure, give them more benefit dollars, so you can see here, over $5,500 per month per person that's available. Not only are they the same between both the male and female, but we're also giving them for a lifetime income stream that they could never outlive. Either one have both of those, that option that they could never outlive. So when we put this plan of care in place, what happens here with our joint structure, we can give them the same benefits, we can give them more benefits, and for a longer period of time. So I really like to show this slide, and you know, when you couple that with that lifetime benefit structure, like I said on the last set of slides here, that gives that true total peace of mind that is needed when long-term care planning is concerned. I also want to talk about our different structures. I mentioned this early on that we have both life and annuity-based long-term care. And there's a couple reasons that I think that's very important. That's unique to us here at OneAmerica, that we have both structures. And it really depends on what the end client's needs are. And there's various factors that could play in here. Are they, you know, advanced in age and maybe failed to plan, and now they're finally realizing that, hey, I really need to put a long-term care plan in place? Well, 70 and above, we tend to look towards our AnnuityCare suite. For those that are less than that, we're typically looking towards our Asset Care suite, which is our life-based chassis. Other reasons to look to our AnnuityCare suite is if they've got some health issues. Sometimes when they've got those health issues, it's better to look towards our AnnuityCare portfolio, because really all we're asking here is 4 or 5 simple knockout questions. There's a MIB and script check that can happen, and that's really it. At that point, it's accept or reject. So we kind of know up front we've got lesser underwriting around the annuity-based solutions. However, with our Asset Care, we have the ability to table rate as well. We're underwriting for both morbidity and mortality. And what can happen there is that gives us the ability to table rate these solutions. So we'll actually table rate on our Asset Care options up to table 8, but table 4 is still our preferred rates. So it really allows us to get more people covered than maybe a traditional plan or some of our competitors in the asset-based space, because we have that ability to table rate. And one of the biggest things that I like about this structure as well is that if we maybe can't offer them our Asset Care, we have the ability sometimes to pivot to our annuity-based solutions based on what their health concerns are. So it really gives us an option to pivot to the annuity side to still offer them some sort of long-term care coverage, putting in that great plan of care. So I like to talk about both our life and annuity structure. And again, if I would just look at the overall decline rates, you know, if we get to that 70+ range, we're talking 44% are decline. This is straight from the American Association of Long-Term Care Insurance. And this stat, again, you can see is from 2017. So this is probably even a little bit older. I would dare to say it's probably closer to 50%, maybe even a little bit higher, 52% this day and age. I just haven't seen the latest stat on that. But with our ability to pivot towards that AnnuityCare suite or starting even on our AnnuityCare suite, we've got the ability to really get a plan of care in place versus putting your clients through an underwriting process only to get declined. And that's never a situation that you or they want. So just wanted to focus on both sides of our solution suite, if you will. And I mentioned this earlier, our 30 plus years of experience. Our first asset care plan was sold in 1988. Our first AnnuityCare plan was sold in 1998. So again, many, many years of building plans, administering those plans, and paying claims. And, when you've got an A+ rated carrier, 96 Comdex, and all that experience, that is something certainly that when you're planning for long-term care, because you're not looking for those plans to pay out tomorrow or in 2 years or 3 years. Certainly they would if the need arose, but you're really looking to plan ahead, could be 10, 20, 30 years down the road before these things start to pay claims. And you always want a very stable and financially sound company that's there for you as well. And that's what we bring here at OneAmerica. So one of the biggest, I suppose, objections, and maybe it's not even an objection because many clients just decide that they're going to self-fund. And I really wanted to show a quick example around this because I say it may not be an objection because if they just don't think about it, they're self-funding. They never want to put a plan in place. They're still self-funding, whether they have that objection that they're going to self-fund, that they're wealthy enough or not. Again, it all comes back to the self-funding aspect. So I want to show you this concept of self-funding and maybe show a better way to do this. But first and foremost, here's a very well-balanced portfolio. You've got your aggressive funds, obviously poised for significant growth, but obviously come with that downside risk, greater downside risk as well. Your moderate funds still poised for that growth, but a little less on the downside risk. And then certainly you've got your conservative funds. These are really meant for preserving capital. Maybe most of them will have guarantees that are built in as well. So that's a well-balanced portfolio. But let's say that we've got a spouse situation or a couple situation here, and one of those spouse starts to need care. Well, what happens? They don't have a plan in place. They decided they were going to self-fund or they never planned for it. First and foremost, they go right to their portfolio and start finding the income needed to pay for those expenditures. So they tap into their portfolio, largely going to probably grab it from their conservative funds, and let's call it $100,000 that they used for that year. Now that may not upset their portfolio greatly. It does impact it, but it's not great. But let's say that's just one need of, 1 year of care need. But what happens if they start needing more and more care? Obviously, you can see how quickly that portfolio can be used up. Now, this could be a smaller portfolio. They may have $5 million. This $100,000 is not going to eat that up as quickly. But there's really a better way when it comes to self-funding, and that is utilizing an insurance company's money, utilizing the leverage that they will provide. So instead of just letting them self-fund and taking those, taking the resources out of maybe their portfolio or whatever plans that they had to pay for any needed care, why not reposition a portion of that portfolio up front and put a great plan of care in place, but really protect the whole portfolio in and of itself? And that's the concept of life-based LTC with our asset care. So here we're going to reposition a portion of that portfolio. In this particular situation, I'm going to call it $150,000. What we do is we leverage that up. We create that life insurance plan that gives the death benefit available to them. So for that $150,000 single premium or repositioning of those assets, here's what we've done. We've created that life plan, given them $185,000 of a death benefit. The death benefit is where they go to receive any of the needed income for long-term care expenditures. So in our solutions, what they do is they tap into their death benefits first. Once those death benefits are exhausted, then they could, well, in the design of the long-term care plan, you add what is called a continuation of benefits rider. You couldn't add this after the death benefit was exhausted, but essentially what would happen is if they exhaust those death benefits, have the continuation of benefits rider in place, that can go up to a lifetime of needed income for those long-term care expenditures. So what a great way to position, especially again in the case of couples, spouses, have them both tap into that death benefit. Once that's used up, then the continuation of benefits rider kicks in. And if they chose the lifetime continuation of benefits, unlimited benefits rider, both of them would have the same LTC benefits continue on for as long as they would live or needed care. So I'll get more into that here as well. As I talked about earlier, we've got both sets, the life insurance base, which we call asset care, and our annuity side, which we call AnnuityCare. Here's kind of the suite, if you will, of the solutions that are available out there. And really, the reason I like to talk about this is these are really, there's a lot of funding options that we have available to create these plans. You know, whether it's just cash they've got sitting on the sideline or in their portfolio or whatever. Maybe it's CDs, money market accounts. Maybe they've got cash value built up in an old life plan that they no longer need for the life insurance. They've outlived that need for that life insurance. Well, now they could 1035 exchange that death or the cash value that's in that life plan and put it towards their long-term care plan. We can also use qualified funds, and I mentioned that early on, and I've got some more information around that here in just a couple slides, but we can use qualified funds. If you look at the retirement portfolios today, most retirement portfolios consist of very much tax-deferred growth or qualified fund sources. So whether that's their personal IRAs, 401ks, 403bs, whatever qualified source they have, we can use those funds to put a great plan of care in place as well. And then not everybody's going to have the ability to just reposition a portion of their portfolio or have that, you know, single premium that's out there. So we also do recurring premiums as well, and that can happen on both the asset care and annuity care side. So I think that's enough on this slide here. I really like to simplify our plans. When I came to OneAmerica a couple years ago, you know, I found it a blessing and a curse. And here's why I say that. The blessing is we have so many options and ways to fund these types of plans that we can really take any customer scenario, any client scenario that you may have, and tailor design a long-term care solution for them that will just put their mind at ease, give them the peace of mind that they need. So that's great. We've got all these options. The downfall, the other side of the coin, then if you will, is that we've got all these options, and many times it can be overwhelming to people. And so you don't have to be the expert. That's why financial markets and their internal wholesalers are there. You don't have to know absolutely everything that you need to know about the solutions that we offer. What I would ask you to do is bring the client situation to your internal wholesaler there at financial markets. Give them the scenarios that you have, and they can use OneAmerica and the suite of solutions that we have and really custom design a plan specifically for them. So I like to try and simplify our options as much as possible. And I really break it down to the very basics. We've got a base policy, and that base policy is either a life insurance, a whole life insurance plan, or an annuity plan. So that's the base policy in and of itself. And then you can add a continuation of benefits rider. That's what COB stands for, continuation of benefits rider. That COB rider can basically double the benefits of the base policy, or, and what I will strongly suggest is that you always plan for the catastrophic and add that lifetime rider. So again, the rider gives that true peace of mind that they can never outlive any income needed for long-term care expenditures. So pretty simple, base policy and rider. So try to simplify it as much as possible. So let's look at a couple case studies as we go through here. Here you see you've got Bill and Mary, age 61 and 60. You know, they recently retired. They have solid assets to cover income needs. Thought self-funding was the way to go until Mary's mom was diagnosed with Parkinson's disease. They started to see exactly how detrimental Parkinson's can be to an individual. But not only that, they started to see the costs that were associated with that care need as well. They own a $200,000 CD, and that was kind of their emergency fund, if you will, kind of sitting on the sidelines. And really what happened in this particular situation, the advisor that was working with Bill and Mary kind of pressed them a little bit or asked some questions. You know, you've got this CD over here worth $200,000. You say it's your emergency fund. Tell me what constitutes an emergency. And exactly what comes out of their mouth, 9 times out of 10, they're going to describe what is a long-term care event. So that's exactly what he discovered here. Also, Bill was diagnosed with diabetes. Now, he was controlling it with diet and exercise, but this is a wake-up call for both of them. So they said, you know, we've got to put a plan of care in place. So here's what we did with Bill and Mary in this particular situation. We repurposed that CD to fund their long-term care plan. And we didn't even use the whole amount of it. We left $50,000 in there. We only used $150,000 for them, but we repositioned a portion of that CD and we funded it a single premium asset care plan. So here's kind of the breakout of how that works. You'll see the timeline there, base policy and rider, but the life insurance policy with that single premium, again, here we go. We created this death benefit of over $184,000 that they would draw from for any long-term care expenditures. Now, there's an acceleration piece that comes with this, and I'll talk about that here in just a little bit. But in this particular instance, we used a 3% acceleration. Essentially, what we're saying there is we accelerated that death benefit over 33 months, which is the 3% portion. And what that does is created almost $5,600 per person per month for any long-term care expenditures. So that's what the death benefit creates, that base policy creates for them. Now, once they exhaust that death benefit from this policy, we also funded with that $150,000. We funded both the base policy and the continuation of benefits rider, and we chose the unlimited option. So once they exhaust the death benefits, what happens is with that unlimited continuation of benefits rider, that continues that nearly $5,600 per month per person of LTC income needed for any expenditures for life. They can't outlive it. It covers both of them up to that monthly amount, and just really put a great plan of care in place for Bill and Mary here. Now, to dive in just a little bit further on the acceleration of benefits here for the death benefit, I like to talk about the different options that we have. We have a 2% acceleration, 3% acceleration, or 4% if it's a single individual only. So that's not for joint cases. But basically what this does is that's the amount of months that we're going to stretch that death benefit out. And that's where we get the 2, 3, and 4% acceleration piece from. I don't like to get into these months because it's really not about the months that are available for them. It's just the pool that they're drawing from and what the long-term care amount or benefits would get out of that death benefit from that policy. So don't get marred down in the months amount here. It's just really, again, that pool of dollars that we can draw from to create those long-term care benefits needed. But if I talked about this, so that's your acceleration. Now, when we add the continuation of benefits, we can either double that amount. So you could have a 50-month plan plus a 50-month plan at the 2% acceleration with that continuation of benefits rider, or you can add the lifetime. I will strongly always recommend that lifetime benefit structure, as you've heard me say a few times. 3%, you can double it, again, 33 months plus the 33 months, or create that lifetime income stream. And again, for singles only, we've got a 4% acceleration option, which would basically pay out over 25 months. If they add the COB rider, pay another 25 months, or give that lifetime. So hopefully that explains a little bit of what's going on there with the acceleration piece. Now, here I wanted to show a single life case, and this was a 1035 exchange from an existing life insurance policy. So this female is age 62. She had cash value built up in an existing life insurance plan that she kind of outlived the purpose for that, if you will. So basically what we did is we did a 1035 exchange into one of our asset care solutions here. And again, we used that to pay for both the base policy and the unlimited COB rider. So that $124,000 split between the two of those basically created a $150,000 death benefit for her. We chose that 4% acceleration. That gave her the ability to have $6,000 per month for any long-term care expenditures. Now, if she would use up that death benefit, again, that's when the COB kicks in and continues that $6,000 per month of reimbursable expenses for any long-term care expenditures. So hopefully that shows a little different scenario here. Now I want to go into kind of our recurring premium options or ongoing premiums. And really what this option is we call it pay to age 95. It still would be a paid up policy. We've got other options as well. We've got single pay, we've got 5 pay, 10 pay, 20 pay, and then pay to age 95. But that's really our ongoing premiums, if you will. So this is exactly how that would work. Now, you don't have to reposition the whole thing. Maybe you want to take it as ongoing premiums and just reposition over, annually for that. So we maybe take the same amount of money, but we're taking them in individual chunks. Again, we're still creating that death benefit where they draw the LTC benefits from and can also fund the COB portion. And again, I'll recommend the lifetime. So here's a case study kind of working through this. Male, female, 52 and 51 with a $4,100 monthly benefit and 3% inflation. What that did was had a annual premium, and I always like to try and keep these around, say, $500 a month, but an annual premium of just over $6,000 per year. So what that $6,000 per year did was create a death benefit of $137,000. Again, we used the 3% acceleration of benefits. So that gave both individuals, the male and the female, $4,100 per person per month for any long-term care expenditures. But that same premium that they're paying then also paid for the continuation of benefits rider. When I added that 3% inflation, we've got an option that will grow it for 20 years. I like that inflation, maybe at 52, 51, you want to choose the lifetime growth on that. But I chose in this particular situation just the 20 years. So this will grow by 3% on the COB portion, those benefits for the next 20 years. So essentially what that does is once they've eaten up the death benefit and they get into the COB portion, after that 20 years of growth, instead of the 4,100 that they had with the death benefit available, once they get into that COB portion, now look what they've got, 7,405 per person per month. But again, they can never outlive that. So I think this structure works very well, even with those younger clients that we're talking about here as well. And again, they didn't necessarily have that single pay portion to drop down, but again, a great way to create a plan of care for those that don't have that. Do the annual ongoing premiums. Qualified money, I mentioned this, and if we look at the average American out there, how much their portfolios are growing on a tax-deferred basis, all that qualified money, most of these portfolios in America today are qualified rich, top-heavy in qualified funds. And having the option to use qualified funds to create their plan, really just repositioning a portion of those to create their long-term care plan to really protect the whole rest of that portfolio. And that's what we're going to be talking about here. Now, this slide is very busy, and I'll apologize up front, but it was a way that I could get kind of this whole concept, if you will, on one particular slide. So what we've called it here is a transfer. And it, I don't know if that's the right vernacular, but I guess it applies here. But what we did here was we used a portion of their qualified funds. So again, we've got Bill and Mary, both age 60 here. We're creating a joint policy. Bill had an old IRA just kind of sitting out there worth $250,000. And so what we wanted to do was use that $250,000 in this qualified solution that we have with our asset care funding option. Now that could be, it didn't have to be a personal IRA, could have been their 401k, could have been a 403b, again, whatever qualified source that they have. What we do with this is we're going to take a trustee to trustee transfer. So no taxation to the clients at the time that we take that transfer over. We're automatically going to give it a 20% bonus right up front. So great way to do that. That transfer comes into our qualified annuity here at OneAmerica. But when we give it that bonus, that $250,000 now becomes $300,000 that we're going to draw from. What we're doing is we're taking it out of the qualified annuity and funding the whole life plan over 10 years. So it's just a simple distribution. You put this in play. You don't have to worry about it. It's set it and forget it. And over 10 years, those qualified funds in our qualified annuity funds that whole life plan, creating the plan, the long-term care plan for Bill and Mary here. Now, I will say this. Because it's qualified funds, the IRS needs to get their money. They're going to get it some way, shape, or form. So when we have these equal distributions, we take that $300,000, we split it out into 10 equal distributions. So it's a $30,000 distribution over those 10 years. But because that was from a qualified source, taxes would be due. But instead of taking a large tax hit up front, we spread it out over 10 years. The clients in those distributions will get a LTC 1099 for that distribution. So know that up front. If you're doing any kind of tax planning with your clients as well, that's always a good thing to just keep in mind that those 1099s will come over that 10-year period. But again, the government's got to get their money somehow. But what those 10 equal 30,000 distributions do is fund, again, the life insurance portion, the base policy, and the COB rider. So in this particular situation, what we've done here is split that 30,000 between both the base and the rider. So 15,736 went to the base policy. That created nearly 300,000 in a death benefit, for both Bill and Mary here. What that would afford them then is almost $9,000 of LTC expenditures or income needed for those expenditures per month each. If they exhaust that $300,000 or nearly $300,000 death benefit, that's when they get into the COB portion, and we continue on that same nearly $9,000 per person per month each that they could never outlive. So what a great solution here. Now, there's a couple other things that I want to talk about with this qualified solution as well. Let's say your client reaches the age of majority, 72 now, and needs to start taking their RMDs, so their required minimum distributions. Let's say they've done well planning throughout their lifetime, and they don't need that RMD income for their expenditures. They're forced to take it, but they don't really need it. Well, these distributions from that qualified annuity could also satisfy their RMDs. So good little point there to point out. And one last point that I'll make on this, inherited IRAs. So any inherited IRAs that are out there, the Secure Act was passed a couple of years ago and now says that any inherited IRA must be a drain and 10 rule. So you can no longer stretch those inherited IRAs out over the lifetime of the person who inherited them. So this fits very well within our annuity funded whole life solution here as well, because since it was an inherited IRA, many of those individuals may be pre-59 and a half, right? Well, the penalty does not apply because it was an inherited IRA. So you could take those inherited IRA funds, use this solution, put a plan of care in place, and not have that extra 10% penalty. So a couple really good things that I wanted to point out with this solution as well. All right, next we go into AnnuityCare. And again, I'm going to simplify it as much as possible. It's just a base policy. It's a base annuity. And then you've got the ability to add our COB rider. Now, one of the other reasons that we like to use our AnnuityCare solution suite is when you've got clients out there who have non-qualified annuities. Maybe that's their safe money. Maybe it wasn't in a CD or a money market account for their safe money. Maybe their safe money was they put it into a non-qualified annuity many, many years ago. And now we've got a lot of extra gain that we're having to deal with. And if they just wanted to leave that non-qualified annuity and self-fund or use that annuity for any care need that would arise, what's going to happen is they're going to be taxed on any of that gain first. So last in, first out. So that's all taxable gain. So if you know you've got clients with non-qualified annuities with, sizable gains out there, what a great solution that you can provide to them. Because if you can utilize the Pension Protection Act, which says that if they transferred, again, 1035 exchanged from their existing non-qualified annuity into a qualified Pension Protection Act annuity, like any of ours in the AnnuityCare suite, then those become tax-free if used for any long-term care services. So we can 1035 that, and all that gain now becomes tax-free distribution if used for long-term care expenses. So no longer having to pay tax on that. If they're using it for long-term care expenses, it's all income tax-free. So what a great way to use it. I look at this, there's really no skin off the back of your clients if they've got that situation, because all they're doing is 1035ing it over. The real pain point for them is just to fill out an application, and that's it. And essentially, you're helping your clients with that anyway. But now you've got a way that can create, they can use those funds for long-term care expenditures on a tax-free basis. And then obviously we can add our continuation of benefits rider here as well. So hopefully that hit home, but I want to give you a little bit more of a case study around this. Now I'm only going through one here, and I'm using our AnnuityCare 2. I'm using this because it's a straight leverage play, really, with Marie here. The thing I will mention about the AnnuityCare 2 solution, this is the only solution that we have that does not have a lifetime benefit option. The only one in our whole suite of solutions that doesn't have that lifetime option. But it's a straight leverage play. Whatever they would transfer to us, we're going to give them 2.5 times. So let's get into this case study. So here's Marie, age 72. You know, she has solid assets and a pension to cover income needs, but she's concerned that LTC expenses will jeopardize any inheritance to her kids. Now, I look at this as just, you know, straight somebody in the, you know, metro area, not dealing with a farm, but I could really take this back. Maybe you have clients that have farms. And if we think about this in the same particular scenario, she's concerned that she'll have to tap in or sell some of the farm. Well, she wants to pass that on to the kids, right? That's kind of what, you know, these legacy plans and that sort of thing has happened in the farming communities. It's just almost expected that you pass that along to the kids. You keep the farm in the family. So you can think about this particular situation in this regard as well. So continuing on, she's over the age of 72. Obviously in the time of COVID, which we're still in, hopefully recovering from, but that prevents her from purchasing a traditional plan or many other hybrid LTC insurance solutions. And the reason for that is a lot of the carriers out there restricted the ages that they would sell or market any of these opportunities for. Now, the only limitation that we had here at OneAmerica was that we could not do recurring premiums over age 70. They could still do any single premium, and it didn't affect our AnnuityCare suite at all. But that was the only restriction. Still in place. It's a temporary thing. It will go away. We just got to get fully out of the COVID scenario, if you will. So she owns a non-qualified annuity worth $200,000. So it's $100,000 base and $100,000 of gain. She did get a guaranteed interest rate of 2.5%. Fairly standard for today's practices. Maybe she could get a little more, 3%, something like that. But we decided to use that instead of just using it for self-funding ability. Let's reposition that, utilize the Pension Protection Act, and put it into our AnnuityCare 2 solution. So let me show you how that works. So the action, if she does nothing, leaves it where it is, status quo, if you will. Here's her $200,000 non-qualified annuity. The outcome of what happens here, if she needs withdrawals for any kind of long-term care expenditures, she's going to be taxed on that gain at her tax bracket. So here, used a pretty nominal 12.5% tax bracket. Likely it would probably be invaded more than that, but that's what we used here. So instead of $200,000 for her, now it's only $175,000 that's available to her. Well, there's a better way to do that. Why not 1035 that and use LTC leverage? So we 1035 exchange that into our PPA qualified annuity. And in this particular situation, we used AnnuityCare 2. That annuity pays for both the base annuity and the COB. So the COB, this is the only plan too that we have the COB automatically put in. So there's some internal charges that pay for the COB portion as well. So we'll leverage that up with that COB. So that 200,000 gives her another 2.5 times. So 300,000. So what she has totally available to her for tax-free purposes for LTC is $500,000. A much better situation than leaving it where it was, right? So what does that do? Obviously, it creates that $500,000 tax-free for long-term care purposes. That $100,000 per year, years of income specifically needed for LTC expenditures. But what we gave her with this particular plan was over $8,300 per month over the period of 60 months or 5 years, specifically for long-term care expenditures. So great way to just reposition this, utilizing the Pension Protection Act, getting rid of that taxable gain. So what sets us apart really quickly, both life and annuity-based solutions, and the ability to pivot if we have underwriting situations. We've got both the joint and single life available. So creating those joint policies where they both share the death benefit or access that cash value goes a long way. A variety of funding options. And like I said, I didn't even cover all the ones that we've got today in some of these solutions. And that's where I say, again, use your internal wholesaler at Financial Markets. They are well versed in our solutions. Bring them the client situation. Let them, put a great plan of care in place, utilizing some of the options that we have here at OneAmerica. Got those optional lifetime benefits, and if you couple that with, even if it's a single life, but those joint situations, that is total peace of mind, not only for the clients, but again, total peace of mind for you as well. Claims Concierge, I'm going to mention this very quickly. Claims Concierge service says this: there is one particular person, they call into an 800 number. Now, this is a tumultuous time for any family when a loved one needs care. So it's not the person who's covered by the policy typically that's calling in. It's usually a family member. So when they call into this 800 number, they're going to get a licensed nurse in Indianapolis at the home office there. They will walk through every detail of the policy, make sure that they've got all the pieces that they need to start any claims process. Not only that, they are the one person that's going to follow them this whole claim process. So throughout that whole claim lifetime, one person is going to be there to answer that phone for them. So they never have to re-explain any of the information that's out there. So great, we get a lot of great feedback on our Claims Concierge service. I see that we're up against time here. Reasonable underwriting guidelines, and really that boils down to certainly having options on both sides. And before I let you go, I really wanted to mention a couple things. First and foremost, this website that's available for you. One of the things that I always find that's hardest for any financial professional or advisor to do is kind of plant the seed or start that conversation with their clients about planning for long-term care expenditures. And we've got a great website here that will do just that for you. You can send this out directly to your clients, and it just gives them some great information around long-term care expenditures and the risks. You come to the end of this interactive presentation, and it has this call to action, ready to take the next step. Reach out to the financial professional who provided you this information. But I can take that a step further. We can actually customize this specifically for you, utilizing our One America Marketing Store, and that's what I'm going to go into here next. The One America Marketing Store has a plethora of information. We split it into producer use and consumer use sides, which is great. Again, many of these pieces are customizable. Print, hard copies, email campaigns, social media campaigns. I love these. These are set it and forget it social media campaigns that we can use on Facebook business section, Twitter, or LinkedIn. And you can put these campaigns in place and let you duplicate your efforts, if you will. You can actually be in more than one place at one time. And again, that interactive website where we can customize. So didn't have a whole lot of time to get into the One America Marketing Store today, but I did want to say, quotes, questions, quips, anything that you need to do, reach out to your internal wholesaler there at Financial Markets. They are there, ready to answer the phone, answer your questions, put those plans of care in place. So with that, I would love to, open it up for any questions if you've got them.
Yeah, Brent, I'm looking at the chat and I don't see any questions. Of course, with your presentation with that wealth of knowledge there, I think you answered a lot because I saw a couple come in and you actually did answer them there. So we definitely want to thank you there. And again, folks, as Brent mentioned, don't hesitate to contact your internal wholesaler, that subject matter expert. They're there to help you turn that suspect into a prospect. And now I'm going to turn it over to Neil Sperling, who's going to lead us and find out who the lucky attendee is. Neil?
All right. Thanks, Ed. Thanks, Brent. You know, one of the biggest takeaways for me with the One America product suite is the word guaranteed. Everything that was displayed to you today was guaranteed. There was not one projection. So when you hear of long-term care premiums going up on enforced policies, traditional long-term care, you don't have that concern with One America. It's just, it's the best plan for long-term care for most situations. So definitely appreciate you going over this with us here, Brent. And everybody that was on the call today is in the drawing for a $50 Amazon gift card. You do need to be present to win. And we will draw the winner. Let's see who it is. Tobin Mason. And let's see if Tobin is on the line here. And congratulations, Tobin, on the winning the $50 Amazon gift card. And I'll turn it back over to you, Ed.
Yes, indeed.
Ed, if you're talking,
congratulations, Tobin.
All right.
Can everyone hear me now?
Sure can.
Can you hear me now? Very good. Well, again, congratulations to Tobin. And thank you all. Again, this is a special group, and you are helping your clients then prepare for tomorrow and tomorrow's and tomorrow's. Look forward to some more webinars to, again, educate us so we can motivate our clients. And thank you again for your business at Financial Markets. Take care and have a good day.